Why don't we start off with yesterday? There was reports from a White House source that the president was very close to firing Jay Powell. The president then spoke during a news conference saying that's highly unlikely. Just that drama, and we saw the action in the bond market, the equity market, and with the dollar. Does that drama change the view of U.S. markets right now?
Look, it matters, but I'm not sure the thing that matters most. When you're looking at what's really driving markets, we keep coming back to technology, in particular AI. You don't have to go back to the beginning of the year when we were worried about AI decelerating, particularly after DeepSeek. Since then, we've had the opposite emerge, and it's just as your former section just mentioned with TSMC. Back in April, we had Eric Schmidt talking about AI being underhyped. We've had Anthropic talk about the amount of compute doubling every 6 months.
Okay.
It's accelerating.
I want to ask, earnings season is getting off to a very early but strong start. Looking at the latest LSEG estimates right now, the blended growth rate's about 6.5%, higher than the original expectation was at 5.7%. If earnings weren't going so well, at least in the early going, would this have all been a bigger deal for the U.S. markets?
Yeah, earnings are critical. And look, they're still being driven positively. And just look at Europe this morning. What's driving the outperformance? And going back to the AI story, it's companies like Legrand and ABB. They're seeing huge lifts in data center growth. So it's all part of that story. So earnings are critical, and tech's a big part of that outcome.
We're going to talk about this much more coming up in the show, but do you see continued dollar weakness following this report and maybe concerns that the Fed's independence could be in question? We actually had Goldman Sachs CEO David Solomon on our air when this news broke, and he didn't want to comment specifically about the report, but he did emphasize the importance of Fed independence and the Fed being seen as an independent agency that makes decisions based on the data, not on the urgings of a leader like a president.
Yeah, 100%. I mean, Fed independence is critical, and yes, if that was in question, the dollar would be under pressure. The fact it's not, I think, suggests that the likelihood of Powell being pushed out is very low. But obviously, if that wasn't the case, the dollar would be a lot weaker, I suspect.
Gary, I want to go to a news alert and get your reaction. Just sit tight for a second. We do have a news alert for you. The FT now reporting the European Union is preparing a list of potential tariffs on U.S. services, also reportedly weighing new export controls as part of a possible retaliation if the trade talks fail. We reported earlier this week that an EU trade minister was coming to D.C. to talk to White House officials. Now, these proposed tariffs will be on top of a proposal for about $85 billion worth of tariffs on U.S. goods, including Boeing planes, cars, and bourbon. Again, a potential tariff on services. Gary, I want to get your reaction to what that would mean potentially for the U.S. markets and also the ability of U.S. companies to operate in Europe.
Look, it just creates more uncertainty, and that's the issue. But it's not unexpected. I mean, this is all part of the negotiation. I think what's important to remember about Europe is a lot of the sectors that are impacted aren't actually driving the market. What's driving the market in Europe are things like tanks, banks, and transition sectors, and they're quite domestically focused, and they've got more structural elements to their drivers, and those are really quite powerful and quite ascendant at the moment. So even if these tariff negotiations are to continue and uncertainty is going to continue with it, I think there's enough domestic sources of price support in Europe that Europe should still be fine.